If the collapse of Luna was cryptocurrency's bear stand movement, Celsius Network threatens to become the industry's Lehman Brothers, the failure that exacerbates a market crisis. I am Manoj Dara and you are watching this special story on Crypto TV, the Celsius and the heat wave. The New Jersey-based crypto lender froze withdrawals for its 1.7 million customers last week, citing extreme market conditions, spurring a sell-off that wiped hundreds and billions of dollars from the paper value of the cryptocurrencies globally. The Celsius blow-up followed the collapse of two major tokens last month that shook the crypto sector already under pressure as soaring inflation and rising interest rate prompted a flight from stocks and other high-risk assets. Markets went into a sell-off after US inflation data, which showed the largest price increase since 1981, prompting investors to raise their bets on Federal Reserve rate hikes. That was likely the key driver of the crypto market nosedive. The rout in crypto markets, which has washed nearly 70% of the largest tokens by market value, accelerated further by the crisis at Celsius as investors panicked about liquidations and a cash crunch. So who is Celsius and how it operates, let me tell you. So Celsius, which resembles a bank while touting itself as a democratized interest income and lending platform, offers high interest rates to investors, mostly individuals, who deposits their coin with these sites. So these lenders, mostly unregulated, which often they have been referred to as, they invest in deposits with a wholesale crypto market. So Celsius has already claimed that on its website that customers who transfer their crypto on its platform can earn an annual return of up to 18.6%. And the website urges customers to earn high and borrow low. So that's what the theme is all about. So founded in 2018, Celsius has more than $8 billion lent out to clients and $12 billion in asset under management by May of this year. According to the company, that's what they have been claiming. Celsius Networks, which raised $750 million in funding late last year, is a significant player in the crypto lending space. Please remember that. Its CEO Alex Mashinsky said in a video in 2020 describing Celsius, who generates a certain amount of profit by lending assets similar to what banks do. That's an interesting theme, what Celsius has been carrying. So Celsius lends them out on a short-term basis, which are not loans. Celsius lends financial assets to players that can transact and generate income for themselves through arbitrage, market making, or shorting certain stocks or digital assets. That's what they have described. So Mashinsky framed this as more conservative strategy than DeFi, in which one lends not to a person or company, but to a pool of assets controlled by a code, albeit with ample collateral as well. So let me give you a macroeconomic perspective and insight of what this APY is all about. So according to analysts, an APY of 18.6% works well in a bullish market where the asset lent to the company increases the value of collateralization. In a bearish market, when value of these collateralized assets shrink massively, such in case of this scenario wherein the prices are down by roughly around 75% from their all-time highs, such payouts become burdensome and the company might collapse under its commitments. So that is big concern as far as Celsius is concerned, its commitments and its way forward. So pretty much similar to what occurred in the subprime mortgage markets in 2008 and 9. So mounting pressure on Celsius, what this story is all about. So every week Celsius hosts an Ask Me Anything on its YouTube channel with states aim of being transparent with the users. The company added that it has also paused its Twitter Space and Reddit very recently and Ask Me Everything sessions to focus on navigating these unprecedented challenges and seeking to fulfill their responsibility and its commitments to the community. So every week since early May, the time of Terra imposition, platform outflows have exceeded their inflows. In the first week of May, the outflows topped $1 billion, with investors pulling liquidity faster than others were willing to risk putting it in. Celsius found itself in difficult position as it has to expand revenue streams in order to continue payout to its ambitious yield to customers. Remember, that's what they have been promising, 18% and above APY is a big concern. So there were 3 red flags raised by the industry. Let me take you through. So first red flag was the CoinDesk, which quoted the core Clipston, CEO of Swan Bitcoin, who said that the red flag came when Alex Mashinsky's claim didn't match up to what its background was. So he didn't have $3 billion in exit and it didn't have the most successful IPO way back in 2004. Second red flag. Another warning sign came when the custodian Prime Trust dropped the firm, citing Celsius' habit of rehypothecated assets or pledging borrowers' collateral as security for its own borrowings. That was a big concern that market is actually having, and it has been a ripple effect on Celsius as well. And the third red flag, the reports of Celsius yanking $500 million from Anchor before Luna unraveled, lead Clipston to further question the risk of Celsius was taken within client's fund. These are the three big concerns which Celsius is actually facing. So the route ahead of Celsius and its investors remains uncertain going forward as well. While the company has remained relatively quiet on social media, on-chain data shows that it is actively juggling funds and loans with market makers and DeFi protocol to ensure that its liquidity on its leverage positions. So it's a very interesting update. Let me take you through. On June 13, it sold some of its stake Ethereum position before adding collateral to a loan on Maker that was near liquidation, a big concern. So stake ETH, what it is? So it's a token that meant to be worth the same as Ethereum. So each staked Ethereum token represents a unit of Ether that has been staked or deposited in what called the beacon chain. So Celsius CEO Alex Mashinsky tweeted on June 15th, the company was working non-stop but has given few details of how or when withdrawals would resume. Celsius said on early this week that it was aiming to stabilize its liquidity positions and its operation. The sector has come under regulatory scrutiny, however, particularly in the crypto markets, have been under pressure in recent months, falling alongside other so-called risk assets as interest rates have risen around the world. The record-setting rout in these cryptocurrencies has put a slew of decentralized finance applications and their communities in a race to protect themselves against a cascade of liquidation. That's all there is in today's special segment. Stay tuned on Crypto TV for more such interesting analysis and stories. Until then, this is Manoj Dara signing off. Thank you.